Hello, everybody. I'm Dominic Hobson, co-founder of The Future of Finance. Welcome to our webinar, The Benefits of Replacing Bogus Tokenization of Securities and Funds with the Real Thing. And we are indeed going to talk today about the different forms of tokenization. But our real topic is why tokenization, despite its many well-advertised and well-understood benefits, is failing to take off. Tokenization of securities and funds is certainly not growing as fast as its keenest advocates predicted. Several estimates have been made of the anticipated size of the global token markets by the end of this decade. In September 2022, BCG forecast $16.1 trillion. In January 2023, HSBC joined forces with Northern Trust and came up with a number of $14.5 trillion. And in March last year, Citi lowered those estimates to just $5 trillion. So there is a wide range of estimates here, but so far tokenized assets fall far short of even the lowest of these estimates. Our friends at stomarket.com put the current capitalization of the global token markets at just $33.5 billion. So even to reach that relatively low Citi prediction of $5 trillion over the next 5 years, the tokenization markets are going to need to grow at a compound annual rate of 130%. To reach the highest of those estimates, they've got to grow at a rate of 180% a year. Now, history shows that the only way to even get close to that sort of escape velocity from the status quo is through network effects. In other words, the more issuers that issue tokens and the more investors that buy tokens, the more valuable tokens will become to each individual issuer and investor, and so each individual investor and issuer will do more of the things that they do. Now, intuitively, it is up to token product and token service providers to make that happen. But it seems our audience today does not necessarily agree with that. As always, with a Future of Finance webinar, we gave everyone who registered the opportunity to tell us what they think. And we're now going to show you a slide summary of your responses to our little questionnaire. Wendy, we have the first slide. Great, we can see that now. Let's start slideshow. This first slide, who can encourage tokenization at scale? Now, when we asked people to tell us what would do most to encourage tokenization at scale, they named not private sector firms, which I alluded to a minute ago, but governments. What do they mean by that? Slide 2, what can be done to encourage tokenization at scale, gives us some explanation of what people meant by that. They mean primarily legal and regulatory certainty and a CBDC, a central bank government-issued CBDC, which would put fiat currency on chain. Our audience clearly think that would help as well. Now, that message is repeated when we asked you to identify the obstacles to tokenization taking off. As you can see, legal and regulatory uncertainty are in first and second place. A CBDC is not far behind in fifth place. In slide 4, we get a bit more detail on what governments can do to help. It's not just legal and regulatory certainty. It's not just a CBDC, but you can see at the bottom there, issuance of government bonds in tokenized form. In other words, governments start to issue their debt onto blockchain networks as well. And over there on the right-hand side, there's a clear allusion to the ideas put forward by the Bank for International Settlements and the International Monetary Fund. There's minority support, which is a very small minority, for a unified ledger or a single programmable platform. In other words, an open and standardized issuance and trading model for digital assets of all kinds, which almost certainly needs to take the form of a public and/or publicly supported initiative. Though, of course, there are an ample number of private blockchain networks which have that ambition in mind as well. So this doesn't need to be a specifically government initiative, but it probably does need to be a public one, whatever that means. Now, true, you can also see on this slide that our audience think that custodian banks and CSDs in particular need to start developing proper tokenization services. They also think that investment banks and asset managers can do a lot more than they are as well in terms of originating and structuring and investing in and issuing tokens. But it's clear that our audience does not think the authorities are yet providing a sufficiently congenial environment for banks and financial market infrastructures, and indeed investment banks and asset managers to invest with confidence in tokenization. So we were concerned not to forget about the question of incentives as well. And however congenial a legal and regulatory environment is, firms are not going to invest if they can't expect a handsome return on their investment. And so the question implicit in the title of our webinar today is this: can tokenization, as it is happening today, deliver enough value to warrant investing in it? And this is our fifth and final slide here. Does the return on investment in tokenization depend on native issuance? As you can see immediately, our audience is equivocal on this question. Only a minority think that the key to higher investment returns lies in abandoning these half-hearted forms of tokenization we have today and embracing tokenization in the fullest sense of that term, by which I mean tokens as digital natives or digital objects that do not exist in any other form, which dispense with any analog twin, indeed with any link to the analog world and its asset class silos at all, and exist on virtual blockchain computers as executable objects only. Now, you can also see a minority almost as large believe that non-native or asset-backed tokenization delivers sufficient value to be worth pursuing, which is just as well, since the security and tokenizations recorded in the Future of Finance databases, details of which are published in the current issue of our Digital Asset Tokenization Guide on our website, are almost all of the asset-backed variety. And that, native versus asset-backed tokenization, is one of the topics we will be discussing today as one of the possible routes for generating the necessary network effects for tokenization to take off. But we'll also be asking whether a US dollar or euro CBDC would help, whether we need some kind of technical breakthrough in interoperability, if that interoperability can be delivered by interoperable public blockchain infrastructures, whether we need to ditch these partnerships between fintechs and incumbents as increasingly a dead end, whether we must perhaps wait the collapse of the existing revenue model, investment banking and asset management before change becomes possible. One recently published book, also reviewed in our Digital Asset Tokenization Guide on our website, argues we must wait for the passing of the current boomer-dominated generation of senior managers in the securities and funds industries, loaded as they are with incentives, by which I mean namely stock and stock options and pension plans. They are highly incentivized to preserve the status quo. And we must therefore await their replacement by millennials and Zoomers that have no memory of why silos and information islands came into existence at all, and of course no stock or stock options or pension plans either. Now, the author of that book may well be right. As Max Planck said of scientific paradigms, a new scientific truth does not triumph by convincing its opponents and making them see the light, but rather because its opponents eventually die and a new generation grows up that is familiar with it. Speaking personally, I hope that I shall see the triumph of tokenization before I encounter the triumph of death, but I confess that it is sometimes hard to be optimistic. However, I'm confident that our three expert panelists are well equipped to dispel the gloom. Rajiv Tumala is Head of Digital and Data, Asia, Middle East and North Africa at HSBC Securities Services in Singapore, which is the global hub for the bank's digital asset strategy and products. Ralph Kubli is a blockchain investor whose interests include a board seat at the Casper Association, providers of the Casper Network smart contract platform for blockchain application entrepreneurs and creators. Anthony Woolley is Head of Business Development and Marketing at Onera, the technology company that connects market participants using FinP2P router technology to solve the problem of industry-wide distribution and interoperability for tokenized assets. In addition to our panelists, we also have you, our audience, and as always, our panelists are eager to answer your questions as well as mine. So again, as always, I encourage everybody watching or listening to submit questions and comments throughout this webinar by using the Q&A functionality at the bottom of the Zoom screen. And rest assured, again, as always, I won't be saving those questions and comments up for some session at the end, but we will endeavour to answer them as we go along, so you can all be an integral part of this discussion and debate right from the outset. Now, I'd like to kick off our discussion by asking our panelists what they think is causing tokenization to tread water. Our audience, as the slide showed, seem to blame primarily legal and regulatory uncertainty, lack of CBDCs, and there is also, if you look back to slide 3, which you'll all get after this webinar, there's a long list of other factors. But I'd like to focus on just 2 of them. And Rajiv, perhaps you could address this first. The first factor is this concentration in tokenizations that have taken place so far on this low-hanging fruit, the real estate, the money market funds, the private equity hedge funds, on collateral management. Those are all areas which don't really threaten the status quo because there isn't much infrastructure there for tokenization to disrupt. That's my first focal point. The second is this seemingly endless focus on experiments, these regulatory sandboxes, getting them all over again. There are proofs of concepts, there are pilot tests, there are collaborations between established banks and fintechs, there are partnerships between them. These seem to prove again and again and again that something is possible, rather than actually doing something. In fact, when I looked through the list of events we keep in our database at Future Funds, I found that more than half of them were these sort of marketing exercises, proofs of concept, pilot tests, kind of what somebody described to me the other day as progress by press release. So are we suffering here from a form of tokenization theatre? So Rajiv, perhaps you could address that. Why the focus on the low-hanging fruit? And are we ever going to see an end to proofs of concept and pilot tests? Is this just theatre?
I think I would basically say path of least resistance, right? So you tend to take path of least resistance. And a path of least resistance is definitely, what makes sense. The business cases that primarily drive the path of least resistance currently focus on expanding access to something inaccessible, right? So real estate funds and private hedge funds, immediately come into focus. There are also reasons it's hard for a common investor to come in and assess the quality of assets that are offered under this umbrella, right? You can definitely use the technology's capability to offer smaller chunks of these assets. But the question always is going to be, is the investor sophisticated enough to sort of consume or invest into this asset, understands the cash flow associated, and are quality assets coming on board for these particular things? How do you assess quality? So those are primarily one of the reasons why I think, it sort of is in the realm of let me test it out. I'll sort of apportion a small quantity of my fund. The other aspect is, if you try to issue new assets, you'll have to go through a completely new paradigm and create the legal and regulatory framework for issuing that particular asset. And that's not easily available, right? So if you go out to an issuer and say you have to spend $500,000 or 750K or $1 million euros, US dollars, take a G10 currency to issue this. Yeah, I mean, as you correctly point out, there's a bit of tokenization theater. Some issuers potentially might be willing to go through the entire cycle to basically get to do that. But is repeated issuance possible on the back of that? Are you creating playbooks? Are you creating something that is repeatable? And those are the questions that the industry has begun to answer, right? So it's easier, probably lower cost, to create a completely new platform and run some of the issuances through, invite a few investors over who are keen to sort of understand the capability and adjust governance onto these platforms. But these platforms also need to talk to each other, right? So you can't, as you know, institutional investors need assets to sweat after you actually buy in. So there should be collateral mobility. There should be secondary use cases for those assets. If it's just buy and hold, it's a very hard sell for a large institutional investor to buy. So that's primarily where I think the digital asset platforms that don't interoperate, and we started creating these islands that don't talk to each other, and then the realization was that there could be 3 or 4 digital asset islands. They can speak to each other. But that's not enough, right? So you could have 4 banks, and then they could have digital asset networks that they can participate in each other, but that is simply not enough. You need to expand accessibility. So one of the primary things that I've learned over the last 6 years, and then I think we have also practiced that in the latest largest digital bond issuance, is interoperability. Means you got to basically work with other digital asset platforms, but more importantly, you should work with the traditional asset networks, right? So that investors should be able to access in a format agnostic way. And this is not the purist way. This is the pragmatic way to move forward, is you make it accessible in an asset agnostic form. And as more investors access, maybe there are incentives for investors who are accessing the more efficient asset format. That's one way, right? So create new assets, make them accessible in an asset agnostic format for scaling. And even if we have these particular things in place, and you begin to issue, like you have a playbook, it's easier to issue digital assets, and you start to begin issuance of digital assets from now. And even from 5 years, if every asset is a digital asset that issue, 5 years from now, you probably have 5% of outstanding assets in the digital asset format, right? So you still have 95% traditional asset format. So one of the bigger things that the industry has to come together is to look at how do you convert existing assets into a digital asset format, and how again, right? So format agnostic asset access becomes the key for scaling. And Dominic, I'll just go back maybe 20, 30 years when most assets were in paper format and then they were all dematerialized. You just took a lot of existing assets and converted them to dematerialized form and then provided access to all of them. You never said, okay, from now on, every asset will be dematerialized, and then we'll let the existing assets that are in paper sort of mature or expire. We didn't wait for that, right? So the industry went through a large dematerialization exercise, and probably that is where, some sort of, government regulatory push nudge would definitely help in making the asset format mainstream. So there are a few moving parts. I would say that there is a maturity curve in understanding what exactly this format does and how it is different, what are the risks. So you need a lot of, I think what I would call as sandbox experiments to get all participants comfortable, right? So there is a maturity curve. Someone comes in a little later than someone else, and they still need to go through that particular learning curve. And then I think experiments, sandbox work is quite critical for allowing people to learn by doing, allowing entities to learn by doing. So you see a proliferation of these things, but you need engagement. That is a proxy for, again, right, learning to get there. I still think that sometimes we always underestimate the change that is required and adoption that is required in the short term. The impact is definitely visible in the longer term, but there are expectations mismatches, right, Dominic? Then you think, again, we are also smitten by the venture capital hockey stick growths. Financial markets infrastructure, financial asset is unlike that, right? So we are to develop an infrastructure that is almost similar to physical infrastructure. An airport is not built in months. A seaport is not built in months. A bridge is not built in months. Similarly, digital asset and market infrastructure is not built in years. It is a
Hold
longer
on.
term thing.
It's a lot easier to build something in software than it is to build a physical bridge.
Yeah.
Could I just pick up, and perhaps Ralph, get you to comment on this? A number of things which Rajiv has said, which I think are open to dispute. One of which he talks about the industry. When I look at our databases, I find there's like 5 or 6 banks, maybe 3 or 4 exchanges who are actually seriously committed to this, just in the sense of being mentioned more than 5 or 6 times in our databases over 7 years. So is the industry engaged? I don't think so. Point one. Point two, he talked very wisely about distribution. When we look at the distributors of investment products, we look at wealth managers, private banks, retail banks, insurance companies, we find they're almost completely disengaged from this process. They're just not interested. The people actually going to distribute these tokenized products are nowhere to be seen. That's point two. Point three is Rajiv mentioned legal and regulatory uncertainty, and clearly our audience agree with that. But on the other hand, there are several jurisdictions, Germany, Luxembourg, Hong Kong, Switzerland, to some extent, Rajiv, even your own, Singapore is among the locations which actually there is a high degree, I think, of legal and regulatory certainty now, and in both Switzerland and Singapore, you see lots of things happening actually as a result of that. But my final point is, Rajiv referred to the dematerialization process 30 years ago when we switched from paper to electronic registers and so on. I'm not sure that that's a good parallel or metaphor for this, because this is something new. These digital objects are not the same as securities turning from paper to electronic form. This is something entirely new, and you know this because the UK Law Commission has had to go away and actually work out a whole new category of property to describe what a security token actually is. So I've thrown a lot of four ideas at you, Ralph, but sorry to throw you in the deep end like that. But I'd be
I will address two or three, and then I think Anthony has really interesting points on actually how it's done, because he's doing it now, right? Mm-hmm. So I mean, he's doing it now. So I would like to address a few topics. One is this dematerialization happened, but it did not lead to a truly native digitization of the instrument itself, right? So we are still representing the instrument. It's just now digitally represented. Already is in ledgers. I mean, all banks have ledgers. So it's, ledger is not a fundamental innovation. So I mean, here in this technology stack. So what needs to happen is the asset itself needs to be truly natively digitized, right? And participants here and some people that see me in the past, we advocate that this be done with an open source algorithmic standard, which both gives you a data model and an algorithmic transition function for the cash flow calculation, similar to an ISTA CDM model, but ISTA CDM does not contain an algorithmic transition function, right? So that is what I would say. And then shortly I hand over to Anthony, because he can really tell us a little bit what is going on. In my opinion, the market has decided that cash and cash equivalents will be tokenized on scale very soon. That for me, that's a clear decision. And why? Because collateralization of cash and cash equivalents is really important. It's well understood. It solves fundamental problem of financial firms and large non-financial firms. There's a huge opportunity for cross-border, transfers. There's no surprise, in my opinion, that JP Morgan, and let's not forget, Finality, which I think started as the universal settlement coin or something it was called at UBS, right? I mean, so the institutions that have large cross-border settlement requirements for their clients came up with the representation on an abstract layer in order to move cash back and forth. So to me, the cash and cash equivalence is clearly going to happen. And it's also easy to understand because it's a one-to-one relationship, right? As long as, of course, the cash equivalence does not depeg from the cash, it's a clear relationship. And the other aspect that the industry decided is fund share tokenization will also be done in the future, exclusively on this new infrastructure. I mean, not exclusively, but, it will move towards this. So those are the two areas where I see.
So just to be clear on what you mean by cash and cash equivalent, you're referring there to synthetic CBDCs. You're referring to the work of the regulated liability network. Tokenized.
Yeah, the deposit tokens, CBDCs, anything that is that is basically representing a cash equivalent.
Okay, and by funds you mean funds existing
shares.
only shares existing in tokenized form, or the underlying existing in tokenized form as well?
No, I think it's clear to me that the fund share business, so fund administrators, etc., that this will move to unified. I mean, this will move to the
units of the fund. I think is where
the units. Thank you.
Yeah, units of the fund.
Well, that's what we're guessing, and that's the.
But I think
background.
Anthony's perspective is interesting because he actually does mobilize, right? These instruments now already. So I mean, I'm not as pessimistic.
Anthony, you tell us. We're getting our first questions in. So tell us, you've been set up by Ralph.
Yeah, and I sat very quietly, haven't I? Which is maybe not very
Yes. Yeah,
characteristic.
we're
for me,
25
but
minutes in and you still
real,
haven't said anything, which is very unlike you.
yeah, real pleasure to be here, and I certainly couldn't resist the title of the panel, which is fantastic. This is a very simple story for me. The concept of tokenization has been around a while. And at the start, you have these ideas and you have these visionaries that understand the potential for it to transform the industry. You then have the innovators who actually start building technology to make it happen. And the innovators built the technology, and then they realized they didn't have any product. So then they're scrambling around trying to find product assets. And initially the assets they found were ones that couldn't get funding or financing from any respectable bank. And they tried to tokenize them, and lo and behold, nobody wanted them. You then had, but everybody still understood the power of this vision. And you had many institutions mobilize tokenization projects, all the labs you're talking about, both on the sell side and on the buy side. And we'll come on to that in a minute. And where we are now over the last couple of years, actually, you've now got fantastic assets, really high quality assets being tokenized, and assets that we think there is demand out there for. The problem is you haven't got distribution. How do you get those assets to those investors? So at Onera, that's absolutely what we're laser focused on. We started by bringing the industry together 4 years ago, saying, hey, this tokenization is great, but we think you guys are going to have a problem, because once you build these tokenization platforms, you're going to need distribution. So we brought the industry together to focus on that problem. As you know, we work with the industry to develop this open peer-to-peer protocol, and I'm an advocate of peer-to-peer, and this is a way of removing intermediaries. But we developed this open protocol, and then Onera commercially, dare I say, we sell router software to regulated institutions. And what does that do? It starts to unlock distribution. And you mentioned a minute ago that's the thing that hasn't happened. That's the problem with tokenization, right? It's a journey. We've had technology's been built, product is there, product cannot be distributed. And all of the projects we're focused on now are taking those projects to production with distribution. How does that happen? I know the way it doesn't happen, which is you don't go to buy-side wealth managers and asset managers and use the word tokenization or blockchain. They're not interested, right? What they want is product, and they want pipeline of product, and they want to know, is the quality there? Do my investors want it? Is it easy to get hold of? How do I invest in it? And if it's good product, they'll buy it without liquidity, right? But over time, they also want a level of distribution that is going to start to deliver liquidity for these assets as well. So I think it's not surprising where we are, and it is a journey. And as Rajiv said, this is a complex space. We're talking about transformation of financial services. But that's where we are. These products are now coming to market. We're involved in lots of exciting products. You can see in the last few months, maybe you could say actually BlackRock in a way fired a starting gun on this, and a few others with tokenized money market funds. There's now people understand the power of having those as yield-bearing instruments, being able to use them as collateral, and there's momentum around other assets. World of Crypto has coined real-world assets out there as well.
Well, I'm very glad you
I think all of this is happening, but it's a distribution problem. It's not a problem even of interconnecting the islands, these tokenization islands. That's not actually really the problem either. The problem is, how do you connect these islands to distribution?
So distributors will get involved if we refer to products rather than tokens, but they're certainly totally disengaged at the moment. Ian Hunt's made a very interesting point on product, which I'll come back to in a second. But Hyun Jing has been asked a question a while ago now. 10 minutes ago. I'd like to address the question asked here. It's, can we go one level deeper? If laws and regulations are the main hold up and proofs of concept are not creating real impact, what are the key things the industry can do together to get the regulators there? That's that public-private collaboration in one of our slides there. Rajiv,
I have a very strong opinion about that, but I'll let the other panelists go first. So I'll tell you.
So the aspect, that's the reason I was sort of going towards this infrastructure upgrade, right? I mean, if you treat this as an asset format transformation, and you had a good point there in terms of this is no longer a dumb entry in a database, which is what dematerialization is, and these are objects, it's a new type of objects. But ultimately, it is an infrastructure upgrade. And we do have this notion of it is software, so you should be able to build it. And and Ralph and also Anthony sort of refer to it, right? Yes, you can build it, right? So building software and creating an asset in the digital asset form, the digital blob, is absolutely easy. No one's arguing against it. It is the distribution. It is the pipes that you need to connect. That's primarily where, you know, the hurdles are there, right? So you need to
Rajiv, isn't the
basically bring it
problem
on.
here that everyone is building software? They're building little software silos of their own. Every blockchain
Correct.
protocol
Yes.
comes along is another isolated universe. We're kind of recreate.
Yeah, but
Yeah.
so here, sorry, so I have two opinions about this. As you know, the first one is you need a truly digital native asset that has a machine readable and machine executable term sheet. If we do not achieve the and standardized, this is the key. This is why the firms that I'm involved in, and there's a few, all build, and I need to pitch this here because it's really important for the industry. This is why we're building on the open source Actus financial standard, algorithmic contract type unified standard. I believe, and I'm deeply convinced, that without standardization of these machine readable, without standardization of both the data model and the transition function, which gives you a machine readable term sheet and a machine executable term sheet in a deterministic way, we will not be able to realize more efficient price discovery and have no chance ever at achieving post-trade automation, which is what people are hoping for by building this new infrastructure.
I can certainly
So
see, Ralph, this is consistent with the single programmable platform, for example. But how do you make it happen? Is this an industry collaborative project, to Tianjing's question, or is it a public sector, private sector collaboration?
So there's two things. So the people that are building these infrastructures, some of them we work with, others, would say that they're too early. Some people agree. So the assets that I described before was cash and cash equivalents and fund shares. And between that, in my opinion, which is basically SPV equity, and in between you have you have debt, structured instruments, and derivatives, which are huge asset classes. If you want to have truly digital native representations of these instruments, or the instrument itself is truly digitally native, you need an algorithmic standard, right? So that's my point. If you want to benefit from this scale, and we don't have to wait for the industry to standardize, we just need pockets of these use cases to use an algorithmic transition function. They do that already now. We just hope that they would use a standard and not just invent their own standards. Otherwise, we're going to end up in the same mess as many people here on the call probably are in deep operational nightmares for interfaces and core banking systems. So that's one. The other thing I'd like to say, before I hand back, what is really needed is, I believe that large non-financial firms will drive the innovation, right? Once CFOs of large non-financial firms understand how much they benefit from cash netting and cash equivalency and repo transactions in this new environment, repo transaction by the minute or something like this, right? Or by the hour, programmable money. Once CFOs and treasurers of large non-financial firms understand the power of this technology, they will demand from the industry to bring more efficiency and equally exciting technology aspects, to debt, structured instruments, and derivatives, and this will be the driver of innovation and adoption.
Ralph, before you hand over to Anthony, Ian Hunt has addressed a question specifically to you, which is, asset agnostic sounds and is a great objective, but to achieve it requires a single operating model and common regulations. Aren't we setting ourselves up to fail if we start from current conventional asset classes and tokenize them natively or otherwise? Regulations and operating models are asset class specific, as financial assets are really just clusters of cash flow commitments, contractual liabilities. Shouldn't we be creating tokens that represent them? In other words, you start from the flows rather than from the structure of the asset itself. Then you can create, he goes on to say, then you can create whatever digital assets you want and have a common issuance and operating model across all of them.
Yes. So let me stay quickly on that, and then I'll open up I'll give you a few more thoughts here for the people to think about. Yes, of course, we agree that it's all about the cash flow, right? I mean, I'm interested in cash flow, right? Because what widows and orphans live off cash flows. I also would like to live off cash flow.
Yep.
You
Yeah,
know,
we all want,
I'm not
we
sure
all want
whether
one
I
of
can
those.
live. I'm not sure whether I can live off Nvidia. Nvidia for the rest of my life. Unlikely. So we need to live off cash flows. So that's why the essence of finance is cash flows. It's the exchange of cash over time, and that is a regulation agnostic. You know, one jurisdiction may classify a certain product that that represents this cash flow as a security, others are not, right? In Switzerland, anybody can issue a bond. You don't need a company to issue a bond. You don't need a financial intermediary. You can just issue a bond. Whether anybody buys it, that's a different story, right? And how they buy it. But you can just issue a bond. It's not it is a security, but it's not regulated. So I think it's important to start with the cash flow. The other point I'd like to make is when we think about the balance, and then that's also a tangent, but I'll open it. I mean, I'll just want to mention it here. When you think about the world's balance sheet, when you think about a non-financial companies, non-financial firms' balance sheet, financial assets, tangible assets, and intangible assets live on that balance sheet. And when you start thinking about in these categories and what we are tokenizing, then the world becomes much clearer, right? We are not just tokenizing an asset. We are either tokenizing a financial asset, a tangible asset, or an intangible asset. And if you think in these categories, it makes the conversation a lot easier. So here we have focused on financial assets, right? But the reality is there's so much opportunity to tokenize and enable collateralization of assets that live on balance sheets that are not financial assets. That's where another piece of innovation can come from, right? But that's kind of like a separate conversation. But so those are the 2 points I'd like to make, right? It's about the cash flow, the representation of the cash flow, the understanding of the cash flow for financial assets, which is key in this conversation.
So you're agreeing with Ian Hunt, right? Rajiv, just before you come, I'd like to give Anthony a chance to come back on another question which Ian raised about product. You know, Anthony, you said distributors want product. Ian's point here is surely the problem is the complexity of the asset classes of the products themselves, not in how we own or by extension distribute them. If it takes, he says here, it takes 16 regulated entities to deliver a simple equity ISA. You know, it's a tax wrapped equity. It doesn't really matter how you own it. It's still absurdly complex. Isn't the real issue the complexity of the operating model, the regulations, and the entities engaged? Now, I suspect lots of wealth managers love that complexity. Because
and there's certainly a lot of complexity in our industry that shouldn't be there, right? One thing I would go back on is I don't think one of the barriers is regulation or governments or or the legal environment. I don't think that's the issue. It is about how do you get the right quality assets to the right pools of investors. If you do that and you've got a strong business case, then everything starts to take off very quickly. Often institutions are seen as slow moving, but don't underestimate, there's plenty of historical evidence of this, of how fast they move when there's a strong business case there, not just a use case, but a business case. And some products have complexity around distribution. And I'm not thinking of it in terms of some of the complexity we've created in the funds industry, etc. But in this space, people talk about, for instance, tokenizing and distributing commercial or residential real estate. Complexity there is getting the right data to the investors, getting them enough information so they know what they're investing in before you can even have a large enough market for then there's somebody on the side if they want to sell it, and can the person buying it get the quality of data. So that maybe has a level of complexity. But what we're seeing with our clients at the moment is you're actually seeing just quite simple products being put in the hands of people who didn't have access to them before. So if you go to a CFO of any private company and they have a bit of capital to manage, and maybe they're a growth company who has raised some money in a Series A or B or whatever, it's actually very hard for them to get yield on that, right? So we now see tokenized money market funds being put in their hands, right? They can get that at a 5% yield. The tokenization and the way these are distributed means that you can start to get fast redemption on them. If you can do that, you start to have a powerful liquidity tool. Can hedge funds, can they use these as collateral, right? Going back to the lovely world of crypto, people sitting on their stable coins, they're not yield bearing. Can you actually swap them for something that is yield bearing? Or can you have a yield bearing instrument that's almost behaving like cash? These are some things we're seeing that have real momentum now. And they're the start, right? Because if you've given that CFO a way that he can get access now to 5% through this tokenized money market fund through his investor interface. You can then give him insured real estate, giving him 8% alongside that. And so it moves forward. So again, I think it's fundamentally a distribution problem, and it's one in which we can connect the asset through to the ultimate beneficial owner in an efficient way. I don't think it's about preservation of intermediaries. It's about peer-to-peer. Can you have the most efficient way to get assets into the hands of investors, to the right appropriate investors, with the right regulatory protection, with the right security to the investor that they're not going to lose their asset because it just got burnt up on a bridge somewhere. You know, we're dealing with, as Rajiv says, the complexity of financial services. But it's this distribution problem. As we solve that, and we solve that by just giving the buy side a bit of router software to plug into their fixed gateway, even that they've already got, not talking to them about you know, tokenization and blockchain, and saying, look, we've got this money market fund, just plug our router into your fixed gateway and there you go, you've got access to the world of tokenized assets. These are the type of conversations that are now moving this industry.
Okay. But Anthony, what is momentum here? When I, you know, 25 years ago, I was in another life, I was chairing roundtables in the collateral management area, where the whole question was, we've got all these assets and all this cash trapped in all these infrastructures all over the planet. It's doing nothing in particular. It's costing us money. Now it's costing us capital. What can we do to mobilize these assets? And all sorts of schemes are put forward to do that. Similarly, with the tokenization of this collateral doing nothing in particular now, you know, we have startups who are trying to address that question. Where's the beef or the sausage, whatever the advertising phrase is? It seems to me these ideas are good. They've been around a long time. The infrastructure is there. It's ready to go. People are not really using it.
I'll give you an example of that very topic. So, and the way these things were done, they're evolved, but there are ways to do them today. So we're working closely with JP Morgan and HQLAX. Some of your viewers might know, listeners might know, viewers. So HQLAX have this wonderful thing, which is they can hold digital collateral records of collateral held by trusted third parties. Now, there are some people that say, well, these are the people that maybe should be disintermediated. But at the moment, they provide the secure place where securities and collateral sits, well looked after and secured by trusted.
Is this happening? Is my question. Is this happening?
HQLAX have digital collateral records of those. So when you update collateral at HQLAX, you actually update the ownership of the collateral. On the other side, we're working with JP Morgan, who have a form of digital cash. And the types of digital cash we have are evolving. Right now, where we are, they have a blockchain deposit account that many people know as JP Coin. What are we doing with them? We gave them both routers, and they can now orchestrate precise intraday repo transactions for institutional repo buyers and sellers. So it means you get an instant exchange of collateral for cash, and it means that you can start to do optimize intraday liquidity. So where the intraday repo market, for those who know it, you're caught by settlement cycles and therefore overnight interest rates. You could do a $1 billion intraday repo transaction and only get charged 3 hours of interest rather than overnight interest.
Yeah, we were talking about that 25 years ago as well. Is this my point? Is this happening, or is this just an idea?
No, it's happening.
Real I think it's okay. Rajiv, we need to bring you in at this point. We're
going to production. So yeah, it is happening. Yeah.
I think so. That is definitely one of the use cases, right? I'll sort of expand as well, right? So one, we spoke about the fact that you are unitizing funds. And if you basically unitize and sell it the same way, it does not move the needle, right? So yes, you can, at max, you can go from branch-based distribution to sort of a digital exchange-based distribution. But what this wonderful technology can do for you is to sort of customize the characteristics of that particular unit at the distribution end, right? So today, how do you customize? Its share class is still centrally managed. You can't do a lot of different charging mechanism. Incentives can't be built in, but you can sort of push the customized product at the distribution end. You can have a master portfolio. You can basically get the distributor to sort of slightly customize it because each distributor has a different set of. Those kind of things are actually becoming visible today. There's a lot of excitement and interest in actually using that. And one of the things that wealth and asset management industry has always been talking about is personalized and customized advised at the end of the value chain. Today, you basically distribute funds that's the same, right? So at the maximum, what end investor gets is a share class, institutional share class pricing. The cost of owning a fund is different, but the
Yes.
the underlying things are the same. And now you're starting to realize that this technology, and again, right, the work that is basically being put in different private and public forms is showing that, okay, this could be one of the tools and vehicles that can be used to deliver customized and personalized advice at
Yes.
scale,
Yes.
right? So there is
Yes.
a trade-off that always existed in financial services. That is, you need scale to produce a product.
Yeah, I think this is what
Right,
Ian Hunt
that
means.
is definitely going away with this capability.
Just
the only
one moment, Ralph, because we just want
Yes.
Ian Hunt, I think, is on this very point Rajiv made. He says, in a fully digital ecosystem, it's not about cash, about tokens. Digital structures will deliver flows
Yep.
of other tokens. In other words, you can create
Sure.
those personalized products that
Sure.
Rajiv is referring to.
Yes.
Sorry, Ralph.
So it's really about the portfolio of one, okay? And
it is a portfolio of one. Product for one is what we call
exactly,
Ralph, right?
exactly.
So,
It's portfolio of one. It's a product of one, which is amazing, which will be possible. The only caveat, again, I would add here is that you need to have a granular understanding of the cash flows that are included in those, and this is a precondition for you to be successful, right? So now Anthony is solving it for well-known assets and maybe not so well-known assets, or people that are interested in buying something that is not so well-known, right? But if we want to have this on scale, because of the size,
be specific what you're saying here, Ralph. The smart contract to write a series of cash flows, I will pay you £500 a year for the next 10 years, has to be, you have to have that standard cash flow algorithm you're referring to.
So for that structured, okay, just because of the size of the asset class, right? That structured instruments and derivatives will need to be defined in a way that you understand the deterministic agreement. So the payment obligations, and of course your rights to receive, right, these cash flows need to be defined in the contract in a machine readable and machine executable form. Now, whether they then live in a bank, in a core banking platform that calculates it properly and then it's represented on chain, or whether this is done on chain, that is to be determined. Whether this is public or private, or whether it's hashed or unhashed, doesn't matter. It's really about the cash flow itself and the opportunity to receive this cash flow.
And Ralph, it is about that cash flow and accounting for that cash flow at the end of the value chain, right?
Yes,
so, and saying, right? So
completely
these things are now possible. This is going to be a cycle, right? So, and there's no such thing, honestly, Dominic, called end-to-end digitization and everybody being on the same chain, right? So there will be parts of the ecosystem that will capture cash flows in the traditional way. But as Ralph correctly points out, there is going to be part of the value chain that's primarily going to capture the digital efficiencies or the efficiencies that are offered by this tech. And you don't need 20 feet deep. You will start off with probably 5 feet.
Exactly.
And the efficiencies automatically
that's
will
where,
drive.
That's where Anthony is. Anthony is at 7 feet or something. I don't know.
Yeah. And then when we've cracked all that distribution problem, everybody will need Ralph, right? But those have we frozen? Did I freeze, Dominic?
No. You're good.
Buffered on my end. What we're seeing in the short term, that these benefits come incrementally, right? At the end of the day, that at the end of the game, you're going to have perfectly modeled assets. You're going to have instant settlement using CBDCs, and you're going to have your assets connected to your ultimate beneficial owners. There's a lot of steps along that way. I'll give you a very practical example, and it comes back to what Rajiv was talking about on the fund side. We know that the wealthy of the world want more exposure and a mass affluent in the right way, for instance, to real estate. The problem is historically had to go and buy a building. You can today invest in funds like REITs, but the reality is they don't give you the targeted exposure you might want to the type of real estate you want. So you can't necessarily invest in a REIT and know that you're getting focused exposure to prime London residential real estate. Still today, the way you have to do it is go and buy a Mayfair apartment, right? So we're working with a very large investment bank and a large real estate company to do exactly that, to be able to tokenize and package much more focused real estate opportunities for investors. It's a very practical thing. It's happening now. It responds to a real demand The reality is large institutional investors, pension funds, etc., are overweight somewhat in these type of private assets. The wealthy of the world are underweight. You know, a lot of what we're doing at the moment is getting high quality assets at least accessible from the institutional down to the wealthy. Maybe the democratization happens that way.
So I'd like to add 2 points, Dominic, if I may. So
But
one is I'd like to add.
Ralph, we're into our last 10 minutes, and I've got a specific question from a member of the audience I'd like you to address.
Yes, I wanted to answer that. Yeah.
Do you? This is from Eric Veerman. It's a good question. Everyone talks about standardization, interoperability of tokens and blockchains. Which organization is best suited to arrange this? SWIFT has a lot of experience in message-based standardization for many years. Would organizations like SWIFT be suited to bring the parties together and hammer out standards?
I agree. I agree.
Ideally, you think SWIFT is the answer?
No. So here's the problem. Here's the problem.
Yeah.
Assuming one answer is a problem, Dominic. There's only one answer. There are many answers.
Here's the challenge. Here's the challenge. In my opinion, the challenge is that the industry first needs to understand that finance that the essence of finance is the exchange of cash flows over time, and that this can be standardized. It's not about messaging. It's not about sending the message who owns this. It's not about the message who can access it. It's not about the message whether it has arrived. It's about the message what it is and what the state of that specific financial contract is. This is, in my opinion, the key. And Actus is an open source standard. It's promoted by the OFR in the United States. There's a number of large institutions that take interest in it. But in the end, we shouldn't try to convince the industry of a standard. That would be the ideal situation. But it needs to be proven. The superiority of an algorithmic standardized approach needs to be proven first at small, otherwise people will not believe it.
What about Eric's question? SWIFT have been at this for 50 years and haven't actually managed to standardize their
No, messaging is standardized, right? ISO 2200,
it's in theory standardized, but in practice it's not.
Maybe if
payments industry, some of the payments industry is going to ISO 20082, none of the securities industry is going to it, the FX industry is going nowhere near it. It's really, the history of SWIFT shows it's really, really hard to get the industry to adopt standards.
Fix is a success.
Yeah,
LEI is a success.
Yeah. If I can add, I think, SWIFT's been very important, right, for the infrastructure of our industry, really from the 70s onwards. We're all somewhat influenced by our experience. And I spent many happy years at Citi in foreign exchange. So I hope they won't mind me saying that. And we had a lot of fun taking the foreign exchange market fully electronic. How did it happen? It happened in the front office because of an open protocol called FIX. Now, I say the word open, but it was actually developed, I think, originally by 3 institutions. Forgive me if I get it wrong, but I think it was Fidelity, Citi and JP. If somebody will tell me if I got that wrong. The good move they did is they made it open under a Creative Commons license. And also it had a key characteristic is that it was peer-to-peer, right? So you just take your FIX gateway and you connect it peer-to-peer to another institution. That's very much an analog for the approach we've taken. We've taken a peer-to-peer protocol from P2P, made it open under a Creative Commons license. And last week we announced an alliance with the FIX trading community to be able to connect that to our routers. Why is this important? Because the thing that people talk about less is balance of power, right? The industry is not going to put one marketplace, one venue in the middle of all of this. Really, if you want the disruption I think you're looking for, Dominic, where you want unnecessary incumbents and intermediaries removed, the way to do that is through peer-to-peer. And what you find is efficiency and good solutions come to the surface.
Okay, that's a very good answer that for Eric. The model is not SWIFT, it's FIX.
I didn't say that, actually. Yeah. What I said was they're all important, but the peer-to-peer model is very powerful. And you need trusted networks like SWIFT when you're moving large amounts of money around. And SWIFT will do that. They continue to innovate with their technologies. And you've got various projects going on, and you want that instant movement of money at zero cost. I think they've got a much brighter future maybe than 1 or 2 other companies, starting with Visa and ending with MasterCard. Right?
I'm sorry if I misrepresented you, but FIX is a good one. We have 5 minutes left. I'd like to sort of wrap our discussion up just by asking ourselves the question, how do we make this happen? And I said in my opening remarks that network effects are the way to make it happen. So the value of the network becomes more valuable to everybody. How do we bring those about? Is it interoperability? Is it this public blockchain infrastructure, which is an alternative, if you like, to interoperability? It's like the internet connecting all these devices, and the World Wide Web connecting all these websites and applications. Do we need something like that to create those network effects? So you may have other ideas other than this, but Rajiv, my thoughts are we obviously need interoperability, and I think we need, I've just written an essay in our tokenization guide, we need a public initiative to create an interoperable platform as well. Where do you sit on making this happen now, rather than just talking about the advantages?
I think you need interoperability for sure, but it should also interoperate with traditional financial infrastructure as well, right? So there's absolutely no doubt about it.
Mm-hmm.
Yeah, and then the other thing is, it is the onus on the new digital infrastructure to create the bridge to the old one, right? So it's easier because it is it is designed with integration in mind. So that's how you need to go. Now you can use Swift or other mechanisms to sort of integrate. That is one thing. The second one is you got to create, again, to answer Anthony's and Ralph's earlier point, you got to be able to create a new product that attracts distribution. It could be the product of one. It could be, collateralable money market funds, or it could be another asset that can freely move as collateral. Collateral mobility, even at a mass affluent level, is going to move the needle, right? If I can buy a fund that someone else is willing to take as collateral and send me out some cash in my way I don't need to enter and exit funds, right? So it sort of goes back to our old adage about be in the market, but use the asset to sort of borrow for some emergency needs, so you are not moving in and out of the vehicle. So those kind of things would automatically encourage adoption of the new product.
Mm-hmm. So Anthony, I noticed Kian Zhang has made a point. P2P is not how it works for post-trade, and you can address that if you want, but I'd also like you just to tell us how we're going to make this happen: interoperability, public initiative, blockchain.
Currently, peer-to-peer is not how it works for post-trade, because the evolution of the financial markets meant that the commercial imperative in the 90s and 2000s was to negotiate orders very quickly in the front office, thousands of orders a second, and not worry about the costs of settling and clearing them. What's fundamentally happening now is a transformation where you will be able to negotiate a transaction, an update record of ownership of both legs of that transaction, whether it's an asset in cash, DVD, DVP, instantly. But to the core question you were asking, I think what you're seeing right now, what's happening right now, is we're in the process of seeing this new two-sided market being bootstrapped. What do I mean by that? You're seeing right now with some of the largest institutions, very attractive assets now being put in the hands of the right type of investors who want them via the institutions that provide good advice to those investors, wealth managers, private banks. And when you have good assets attracting the right sort of investors, more investors want access to those assets, and then assets come because they want access to the investors that are accessing those assets. That's the process we're going through at the moment. It's not a story of linear growth. It's a story of nothing happens for a while. You build technology, you get product, you distribute the product, then you have a business case because you put a very valuable tokenized money market fund or collateral instrument in the hands of an investor, and then it takes off. And I think that's what we're seeing at the moment. We have many projects now going to production. When it takes off, everybody's going to need Ralph's well-calculated cash flows.
But if it's not linear, I'd like it to be exponential, or at least
It
quadratic.
will.
Ralph, last word from you. How do we?
That's amazing. Thank you.
How do we get network effects?
So we get the network effect by some of the first larger financial institutions utilizing this technology, including this algorithmic standard, to securitize large books of debt on a nearly automated basis and distribute these securitized pieces exactly in what Rajiv described, in a portfolio of one, where they can go to capital providers on an extremely low cost basis, nearly automated, and securitize down to a very small amount of issued debt, for example, on scale at a risk return adjusted yield for the interest of the capital provider. Once this is in place, and it will happen very soon, I would say you will see this in the next 12 to 14 months, with or without settlement on chain, you know, in a digital form, then the industry will understand what this technology can do for them.
And with that, I think we must stop because our time is up. I'd like to thank our panelists, Rajiv Tumala from HSBC. Thank you, Rajiv, for joining us. It's probably not exactly beginning of the day for you, so thank you. Ralph Kubli from the Casper Association, thank you. Anthony Woolley from Onera, thank you also. Here at Future of Finance, our next webinar takes place about a month's time, Wednesday, 26th of June. At it, we're going to be discussing what stock exchanges should do about our subject today, namely tokenization. Before then, you'll have the opportunity to attend our Digital Money one-day event, which is taking place here in London, 8 till 8 on Thursday, the 13th of June. And at it, we'll be talking about some of the things we talked about today, very briefly: CBDCs, tokenized deposits, stable coins, future of digital payments, and even perhaps the death of cryptocurrency. And if you want to know more about what we were talking about today and about tokenization in general and in Japan in particular, do download our digital asset tokenization guide, which is available free on our website. But for now, it's goodbye from the four of us. Goodbye.
Thanks.